All right. So good evening, everyone. This is our first tax law session with Jared Miller, who's our facilitator for this, for our tax law sessions. I'm really excited to see some familiar faces. I know we have a number of folks that are new to our videos. We have some new folks that are new to the United Way of Lancaster County. And so we're really excited that you all are here. For those of you in Lancaster County, we will be having a presentation next week from Bob Hamilton, who is with Mid-Penn Legal. And this is a resource that you are able to refer to for anyone who might owe taxes, might be having some issues with taxes. They're our local organization that helps with folks. There's another name, but right now I can't think of it. But Bob will be coming for a few minutes next time. Many of you know that this year there will be a new intake form going from a 4-page to a 6-page intake form. And I will send that out either tonight or tomorrow so you guys can get a look at it. There is a training that the IRS did on October 29th, and they will be sending the recording and the handouts to me. I have not gotten it yet. I just got one that was the week prior, so it could be another week or so until I get that. But once I do get that, I will send it out to everyone so you can take a look at it. It is not finished. It is still in the process of being finalized. So as soon as it is finalized, the IRS will print it out and then we'll get it out to us. But I think it's going to be something that you guys will like. There's not a lot of additional questions. It's more of tweaking the questions that are already on the form. When you look at the form, where they ask the client, do you have W-2 income? Do you have 1099? Those questions. They have made half of the column for the client to answer, and then the other half is for you as a tax preparer to answer that you did ask and you did verify the information that the client gave you. So it's going to be something that's going to be very beneficial to you guys, I do believe. So I will get that out. Like I said, it's not the final copy. They still have to get some final approvals from OMB, but as soon as that's done, we will have the new form. One of the things we are going to talk a little bit about tonight is the non-resident versus resident alien. And I am encouraging folks from our sites to get that certification. It is something that we are seeing more and more of. Lancaster County is definitely an area where there are a lot of refugee organizations. And so we've been working with them the past couple of years to help their folks. So if you are interested in taking that, I will be sending some links to different resources. Once Lincoln Learn is back up, they definitely have resources for those certifications and your 6744. The tests are in there, so you'll be able to look at those ahead of time. And I know there's a group called Prosperity Now. They also have some really good trainings for the different certifications. So I will be sending those out again. Anything that I'm mentioning for you folks that aren't from Lancaster County, shoot me an email and I will get that to you if you would like it. I think that is it. So I am going to turn the mic and screen over to Jared.
All right. Thank you very much, Kim. Hopefully everyone can hear me all right through my Time Life selling headset here. Hopefully that audio comes through all right for you. As Kim mentioned, this is our first in a number of series here talking about tax law training. Tonight we're going to be covering the aspects of dependency and then also filing status, so, as well as some updates here with tax law changes, and then also touching at the very end on some resident alien, non-resident alien type issues as well. So I wanted to go ahead and share the presentation here with you. And hopefully this will come through all right.
Yep.
Okay, wonderful. Yep, just working with a multiple monitors here, so just making sure I can get it to pop up on the correct screen here. So hopefully we're able to go through and take a look at the slide deck presentation. If you have any questions at all, feel free if you want to go ahead and either enter them through chat, or if you want to go ahead and just raise a question with me, that is fine as well. So wanted to welcome you to our first of our 4 tax law training sessions, and really to kick off a little bit with just a couple updates. We are, as you probably can tell, in the midst of a election year. So Congress has not changed any substantial modifications to the tax code this year. The tax deadline is still going to be April 15, 2025. For those that are new to the VITA program, you may wonder why is it not always April 15th. This year, we do not have the tax deadline falling on a weekend or even a local holiday, whether Emancipation Day in Washington, D.C., or Patriots Day up in Massachusetts. So our tax deadline is our traditional April 15, 2025. Good news as well. No major changes to the Form 1040 from the 2023 year. There are a couple little updates that we have, predominantly related to maybe some input areas. So when we take a look at the Form W-2, which we'll talk about next week when we talk about income, there is now a new checkbox and a code for Medicaid waiver payments that are going to be excluded from income. So we'll mention that, but now it's a little bit easier to go ahead and do that, a little bit more intuitive than digging through the system. We also have another line here in the Form 1040. There's a checkbox if you would go through a lump sum election for Social Security benefits. And if you have no idea what I'm talking about so far, not a problem. These are a little bit more unique items when it comes to income reporting on a tax return. So we'll cover those a little bit later. When we do take a look at another area, one of the big questions we had last year was this concept of 1099K reporting. Initially, the aspect was for 2023 that threshold was going to be fairly low. That would be for anyone who had any transactions going through whether a credit card payment or an online cash payment methodology, whether that was a Venmo account, a PayPal account. That has now changed. So it is down to $5,000 for 2024. That's the threshold for someone to issue a Form 1099K. But there may be some times that we may see those at lower amounts. So there is a good update here on the Form 1040 Schedule 1. There's now an entry field for someone who may have gotten a 1099K in error, or if they have personal items that they sold at a loss, or they have a lot of reimbursements coming from friends and family that are triggering a filing threshold. So again, we'll talk about the Form 1099 series next week. But the great news is not a whole lot of tax changes from the prior year. Next year at this time, we may be changing that up a little bit. But certainly for this year, not a major amount of changes that we're expecting here for the 2024 tax year. One of the first things we take a look at is who must file an income tax return. And just want to point out, we actually have a reference in the upper corner of these slides. That's actually a reference to your 4012. So there's a chart on A3 of your 4012, which I've simply duplicated here for reference purposes. There are a couple things that we need to know in order to file a tax return. One is a filing status. We're going to cover all 5 of these a little bit later on today. We're also going to cover gross income. So gross income is a concept that we'll take a look at of how much income does an individual have. And that will be after we apply Social Security limitations and a couple other things, again, to be covered next week. The middle column is always one of those most sensitive ones where we have to know the taxpayer's age. For those of you who have not done VITA before, don't worry, you don't actually have to ask them their age. We're going to have that information because they're going to provide ID to go ahead and have their return filed. So we'll have that in the system. So it's automatically going to calculate whether they're under 65 or 65 or older. Avoids that delicate question about how old are you? But we can go ahead and determine their filing status by one of the 5 categories. We can identify their age through the system, and then basically the gross income would help identify whether or not that they need to file a return. Now, what that gross income threshold is, what you see on that right-hand side of the screen, is really the standard deduction that's eligible for each tax-paying individual within the U.S. So these have gone up from prior year. They actually went up a little bit higher than I think we had anticipated. So basically, if you're a single individual under the age of 65, you can earn up to $14,600 of gross income without having a federal tax liability. That's effectively what we mean by this chart to say 16,000 for 16, I'm sorry, $14,600 is the amount that you can earn and still be under the standard deduction. Now, if you're 65 or older, that amount actually bumps up a little bit here and is a little over $16,500. In fact, $16,550. For married filing jointly, what you'll notice is actually if both are under 65, it's exactly double that of a single individual. So married filing jointly, that is now up to $29,200 before we can itemize deductions. That's a category we're going to talk about a little bit more in our third week here. Talk about deductions available for returns. Now, if an individual is 65 and just one, we get a little bit more of a standard deduction. If both couples both individuals are over 65, that's going to bump us up to $32,300. My apologies. I'm not quite sure why I can't read the numbers off the board here correctly, but I will make it known I do not memorize any of these numbers for the main reason they are going to change each and every year. For married filing separately, doesn't really matter your age. The gross income threshold, you may notice, is a bit of an outlier. It's $5. If you're going to file separately, if you have more than $5 of income, which I'm assuming most people coming in to get a tax return filed will have more than $5 of income, they will probably need to file a return. And we're explaining a little bit more when we get to the married filing separately category that the $5 threshold is going to be for a very particular reason. And also why we don't highly encourage married filing separately unless it is going to make sense for the taxpayer. We'll talk about the two more higher elevation of filing status. That's head of household. There are going to be a couple things we need to make sure that we're complying with the IRS law about what head of household looks like. But you'll see that those standard deductions are a lot higher than just a single individual. So about $7,300 higher of a standard deduction. I mean, you can earn $7,300 more income without having to pay taxes. The last one we're going to talk about, qualified surviving spouse. These numbers are exactly the same as married filing jointly. So the filing threshold, the same, $29,200 is our standard deduction. And then also, if you're 65 or older, that would get you another amount here to put you up to $30,750. Now, again, why I basically mention this is really for IRS testing purposes. So when you take your certification exam, quite often there may be a question or two about who must file. So I just wanted to show you the chart and to go ahead and explain how this would work. Now, again, we're online, makes it a little bit tougher to do an interactive environment. But if I gave you an example to say Bob is 27 years old, a single individual, and has earned $17,000 of income for the year. Do we think that Bob would have to file a return? Yes. Okay. So single under age 65, if he's over 14,600, he should be filing a return. How about if we have Janet and Harry? They're married. They usually file jointly during the year. She turns 66. He's 64. And they have a gross income of $19,800. Would they need to file? And in that case, we'd be looking at the chart here. That would mean that they do not actually need to file. They would be under the $30,750. We're going to talk a little bit more about why they may want to file, but technically, from an IRS perspective, they are not required to file. We had Juanita, who is a dependent child, and she could file qualifying surviving spouse. She is 47 years old, and her gross income is $29,400. Would she need to file? She would. She's $200 higher than this $29,200 threshold. So in that case, she would need to file a return. So just to let you know how we could utilize this chart to see if an individual actually does need to file a return. We'll talk about the filing status. Usually the IRS will either tell you what the filing status is for the exam, or another question maybe to help determine what an appropriate filing status will be. Again, we'll cover that a little bit later on this evening. Now, even if they don't fit into the chart, there's another area where taxpayers must file. So again, on A5 chart C, there's some other areas that might require tax filing, even if their income's beneath the filing thresholds. If they have net income from self-employment, so that's at a $400 level or higher. So this is net earnings. This is income minus expenses. If they have $400 or more of net earnings from self-employment, they will need to file an income tax return. The reason why is they're most likely subject to self-employment taxes. So $400 is our threshold. Self-employment income, we're seeing a rise of this throughout the VITA programs. This may be individuals who have determined that they are going to be doing some side business activity. Could be driving for a rideshare service. It could be selling items on Etsy. Maybe it's going ahead and doing some contract work or some self-employment work on the side. If they have more than $400 of net earnings, they would have to file a return, even if their gross income is beneath those thresholds. Another one that we take a look at here is that a distribution from a retirement plan. And if that distribution is taken out early before the taxpayers reached their normal retirement age, oftentimes there may be a tax or penalty associated with that withdrawal, and that would require the filing of a return. Another one could be, we still see a couple of these floating around. There could be some monies that have to be repaid to the IRS. The biggest one we see is really the repayment of the first-time homebuyer credit, which had been in existence here right at the mid 2000s. I think 2008 is the year in which that started for the repayment. So we still have a couple of these floating around here. Hopefully, we're near the tail end of those, but hopefully, the taxpayers already been repaying this back for over a decade, so they should know that they have a repayment of the first-time home buyer credit. And then at the very last area here, you'll see that we have something in bold. It's red, it's highlighted, which probably means either it's a vocabulary word from grade school or it's important. Well, in this case, it's going to be important. This is going to be when an individual has received an advance premium tax credit to help pay for health insurance. Where they're going to get this advanced premium tax credit is they would have applied and received insurance from the marketplace. So if they went out and went either through their state website or through the healthcare.gov and they received medical insurance, quite often they're probably having a credit applied to their monthly premium. Now, that monthly credit is basically on an estimate of how much income they have for the year. So at the end of the year, we need to file a return and see how close they were to that estimation of income. So if a taxpayer receives a Form 1095-A, we do need to file a return. In fact, the IRS will reject any electronically filed return that does not have information from the Form 1095-A. So we need to be sure that we have that information from the taxpayer, and it could result in maybe more credit, or it could have some monies owed back to the government. So those are some examples of things that we may have some areas where people may not necessarily fit the chart on the front, but they're still going to be required to file. Now that kind of brings us to the point, who should file? And the answer generally is anyone who walks in the door that we can prepare their return. So there may be a lot of reasons why people want to file a return, even if they do not meet that threshold from our initial chart. So if we take a look at A6 in our 4012, there's a chart D that says, what are the other reasons why we may file a return? Well, the predominant one is if you want a refund of federal taxes you had withheld, or that you made any estimated payments or had an overpayment from the prior year, the only way to get the refund is to file an income tax return. The government's not going to estimate or guess or think that you need a refund. In order to claim a refund, you must file an income tax return. So that might be one of the reasons we have a number of individuals coming in and filing with our VITA program. Another area could be if they receive a Form 1099-B, which is actually a brokerage statement. This is where you might be selling off stocks, securities, bonds, something along those lines. The government's going to get a copy of that. Hopefully, they should also get a copy of the cost basis. Again, we'll talk about that next week. But in order to make sure that you're reporting the correct amount of income, you should file an income tax return. Same with the Form 1099-S, which is actually a sale of real property or some sort of either a personal residence or maybe a vacation home or just land. If a taxpayer does receive a Form 1099-S, we can go ahead and report that on the tax return as well. One of the very, very big reasons why, again, as I mentioned, the IRS will not automatically grant a refund. In order for you to get your money back, you have to file a return. And there are some incredibly powerful credits that the IRS has on the tax return. The biggest one we'll talk about, that's going to be week 3, is going to be our earned income credit. So that's a refundable credit. Even if you don't have any tax liability, you can still get money back. Same with the additional child tax credit. There may be a refund opportunity that's there. Also, the refundable American Opportunity Credit, which is an education credit, there is a portion of that that is also refundable. So we have to make sure that in order to claim those, we have to file a return. There could be some people eligible for recovery rebate, but I think one of the big things we may see here in PA is senior citizens who might be eligible for the property tax or rent rebate credit. So we actually do have people coming into our VITA site that are only coming in because they are going to go ahead and request that property tax or rent rebate. We can still go ahead and prepare that return, even if they don't have a federal or state liability. We'll talk a little bit more about this as we go through, but even if they don't have any federal taxable income, you can still file a federal return. We just have to go ahead and create a scenario where they have $1 of income. Usually to do that, to e-file that return, we'll go ahead and enter in $1 in the other income box. That's basically going into, there's an income category, there's a less common income drop down, and from there we'll go into other income not reported elsewhere. If we type in a description in order to e-file, you put in $1. That is not going to change their tax situation at all, but it does provide at least $1 of income to be able to electronically file. So just one opportunity we have if you're filing only for the purpose of doing a PA property tax or rent rebate. And we do see a couple of those coming through here in Pennsylvania. Now, a couple things we want to address here before we get into more tax law issues. Whenever we have a taxpayer come in, we want to be sure that the income tax return is the current mailing address for the client. So it doesn't really matter where they lived during 2024. When they come in to have their taxes prepared, we want to be sure that the address on the income tax return is where they're currently living. That way, in case there are any issues, the IRS can go ahead and either mail refunds or mail notices to the correct address. So even though that address may be different from the prior year, may be different from things like the W-2 or 1099s, that's fine. We just want to make sure that the current mailing address is on the return. A couple other things that we're going to have as well will be to make sure that we have any adjustments for our local earned income tax. So that one is here in Pennsylvania dependent upon where the individual had resided. And that one we may need to go ahead and do some dates of moves or add some additional information. So we'll talk about that one in a little bit. Okay, and it looks like, Kim, I don't know if I just saw something pop up in the chat. I'm trying to get over to that here. I don't know if there's anything pressing on a question there.
I think that might be for me. I'm Peggy.
Oh, hi,
And
Peggy.
I thought I heard that the IRS was stopping our ability to e-file by adding $1 worth of income that they didn't really get.
Hey,
We
Peggy,
could,
if I could answer that question for you, Johnny V. Um, you cannot e-file a return with no income. So you have to add the dollar because
That's
it's
what we
just going
did.
to reject.
Yeah, that's what we did in the
It'll reject.
past. I know that's what we did in the past. But I
Right.
thought
Well,
I saw where the IRS from one of those website meetings that they just had, they're stopping that. I'm not sure, but that's what I thought I read. You have to do
I
a
don't know.
paper, you have to file by paper.
and we could certainly check into that. I know the IRS has been actually leaning a little the opposite way in trying to ensure we have as many returns e-filed as possible. So we can double check on that and just make sure that as we get closer to filing season, we may get a little bit more here toward some guidance on how the IRS is going to process that. So we'll definitely let you know, Peggy, of how we're going to be there.
Okay, thank you.
Yep, absolutely. Yep. I appreciate that. And now I figured out how to go ahead and bring the chat up at the same time with the
Oh, you got it?
multiple now we got it. All right. I
Okay.
appreciate that. Yeah, so I'll be able to keep track of both of those at the same time. If you have any questions, feel free either put it through chat. I'll try and keep an eye on it there, or we can also go ahead and take a look here for purposes. Feel free to unmute and ask me a question as well. I'm not on a timer. I mean, it may feel like I'm a teleprompter here because I'm looking at a screen while I'm talking, but can certainly take some time to answer questions. Going back to Richard, you had a question about the Medicaid waiver. So that would be excluded from income tax. That is correct. But it can count as earned income for the earned income tax calculation. So absolutely, we can go ahead and take a look at those. It's a very powerful opportunity. It also works very similar to combat pay, which we'll be talking about next week here. So happy to answer any questions that you may have.
Let me pull it up and turn this site off, but not the sound. But that I didn't have any chance to check either.
All
See,
right.
maybe you're not hearing their question. They should have that loud enough. But I don't think they do.
Yeah, we can hear you.
See, that's the problem. You're not.
All right. Well, let's go ahead and switch over to a little bit of the tax law portion here. So wanted to get into the area of dependents. And out of curiosity, do we have any brand new people on the call tonight who have not prepared returns before? Okay, I'm taking that as a good sign. No one's volunteering and no one's been scared away yet. I always keep an eye to see who's dropping off on the call as well. So that's hopefully a good sign that we can help you out here. We are going to be talking about a couple different issues with tax law tonight. One of those is going to be dependency. What we're going to take a look at here are the rules for a dependent. Just as a reminder, even though you may have a prior year return coming in or a taxpayer may say they have done something in a prior year, we do have to evaluate that each and every year. That'll be for dependency purposes and also for filing status. So again, dependency is going to be covered in your 4012 in the C section here. So we have the C3. In order to claim a dependent, that the taxpayer cannot claim any dependents if that individual or his spouse, if filing jointly, could be claimed as a dependent. So we want to emphasize the word could. So if you are eligible to be claimed by someone else as a dependent, you cannot take any dependency exemptions yourself. Main reasons the IRS figures if someone else can claim you as a dependent, then theoretically you should not be able to claim anyone else. So as long as you are not claimed or could be claimed as a dependent, you do have the ability to take a look at the dependency exemptions. A couple rules that we have here for the dependent. The dependent themselves have to be unmarried. And I'm going to go through a couple things with the IRS here and the IRS rules. So we're going to talk about a rule, then I'm going to go ahead and give you an exception, and then an exception to the exception of the rule. So we're going to find a lot of interesting things with the tax law here this evening. One will be trying to keep up with definitions. We're going to throw some very unique things out at you here, including what we may perceive as a child or a qualifying relative, but also rules may have some exceptions and then an exception to that exception. Hopefully we don't go much further to an exception to the exception of the exception, but we'll find out how that goes. So typically the dependent has to be unmarried. However, if they are married, they cannot file a joint return. But then we'll have another exception to that to say they can be married, they can file a joint return as long as the joint return's only to claim a refund. We probably don't see that all that often. This would be a situation where you may have a dependent child who may have gotten married. I've seen it a little bit more closer to military bases as an individual may be now moving to active duty, and before they're deployed, that the couple decides to get married. However, the one spouse may not actually live on base, may still be living at home, may still be considered a dependent of his or her parents. So we may have an opportunity there to still claim a dependency exemption. However, I think that situation is relatively rare. In addition, the dependent must also be a U.S. citizen, U.S. resident alien. So we'll talk about the difference between resident and non-resident aliens a little bit later. Has to be a U.S. national or a resident of Canada or Mexico. So we're basically taking a look at someone who's actually residing somewhere here in North America. There are some special exceptions for adoption cases. So if adoption's in process, they're not actually a U.S. legal citizen yet, we do have that opportunity. Again, a little bit more rare in the VITA context, but that still could apply. And they're going to have to meet one of two areas here. So one of the things we have to take a look at is either it's going to be a qualifying child or a qualifying relative. So continuing on C3, there is the definition of qualifying child. And so I mentioned this as I actually teach my students at college. I want to have you suspend your belief in what the definition of a child is for a little bit. So in our own minds, we may think we know what a child is. We can help define what that looks like, but we're going to have a slightly different definition here for IRS purposes. We'll actually see the definition of child change between dependency and a couple of the credits we'll talk about a little bit later on in our tax law training. So in order to be a qualifying child, we have to meet a relationship test, which is that first one you'll see on your screen. And that's going to be that the individual has to be the taxpayer's child, stepchild. Okay, we're okay. I think we're all on the same page that child or stepchild counts. Also adopted or foster child counts. Okay, so we're looking at a direct child relationship. But then we move on to brother or sister, including a half brother, half sister, stepbrother, stepsister, or descendant of any of them. That includes any niece's nephew. It includes also your own descendants. That could be your grandchildren, great grandchildren can count as a qualifying child. Now, what we're going to take a look at here, it is a bit unique when you see a brother or sister come into this relationship. So we'll talk about how that's going to work. But it does include any of their descendants. So that could be a niece or nephew, as I mentioned. But there may be a situation where you have a taxpayer who may be taking care of younger siblings. And we'll take a look at the age test in just a minute here. But the IRS does want to provide an opportunity to claim those individuals as qualifying child of the taxpayer. Again, so if we have a situation where we have a taxpayer who's taking care of younger siblings, they might be the primary provider, that they would be eligible to take their siblings, brothers or sisters, half brothers, half sisters, stepsisters, as a dependent. Now we have to meet an age test. So the next test we're going to see there is the age test. They have to be younger than the taxpayer or the spouse, and either under the age of 19. And I'm not a huge fan of these under categories because you see a number of 19 and now you're thinking, okay, 19 is our magic age. It's actually 18. So it's under age 19. So we're looking at by the end of the tax year that individual is still under the age of 19. So we're going to take a look at their age as of the end of the year in 2024. So as long as they're younger than the taxpayer or spouse and 18 or younger, they could be a qualifying child. Or they could be a full-time student under the age of 24. So again, up to the age of 23 and a full-time student. Now, again, we want to have you kind of suspend your thought on what full-time means. If we're thinking full-time, we might be thinking a full-time work arrangement, meaning that you're going to be working basically every week of the year, absent some vacation or holidays. You're probably working more than 32 hours a week. That's what kind of we would normally think of full-time. Under the IRS definition, it's a little bit different. So a full-time student means that you're a student at least on a half credit load at an institution, meaning that we take a look at the school and they'll determine whether or not you're meeting a at least half-time enrollment category. And it's not for the entire year. What we're looking at for a full-time student is it's any 5 months, any part of 5 months throughout the year for 2024. So the good news is when we take a look here at usually how college semesters will run under a traditional model. For example, a fall semester, students will generally start their program in August. They'll be there for August, September, October, November, and then maybe just a couple days in December. At E-Town College, we end relatively early. It's the first or second week of December when we're done classes and doing finals. But that doesn't matter as long as it's any part of 5 months. Similar to a spring semester. So that would be January, February, March, April, and then usually graduation in early May. That counts as a full-time student definition. So any part of any 5 months and at least a half-time load, they are considered a full-time student. So that's where the age test comes in. They have to be younger than the taxpayer and either under the age of 19 or under the age of 24 if they're a full-time student. Or they could be any age if they're totally and permanently disabled. So we've taken away the younger category. I actually have a client of mine who has a sister who is has a fairly significant disability. He is providing her support, so he is actually able to take her as a qualifying child, even though she's an adult. So any age if they're totally and permanently disabled. So a couple things we also take a look at here. So we have the relationship test, we have the age test, now we have a residence test. So they have to live with the taxpayer for more than half the year. Now you may ask, what happens about a student that's away at college? Well, the good thing is temporary absences do not count against you. If they're permanent homes with you and they're away temporarily, that does allow the taxpayer to still take them as a dependent. So when we're looking at temporary absences, some of the biggest ones we're going to be taking a look at here are things like education. There's also some other examples for, I don't know why vacation comes up on this list. If you have a child who has, a couple months of vacation, they're spending it away from you, that's a temporary absence. It does include things like incarceration, would include military service, would include illness or employment opportunities if they were traveling. But those are considered temporary, so those are not going to impact your more than half the year. Also, we take a look here at the child cannot provide more than half of his or her own support. So we're not asking who did. All we're asking is the child did not provide more than half their support. So what does that mean? If a child is out working and maybe they have a part-time job or maybe they have a fairly significant amount of income they've earned, as long as they're not using it for their own support, as long as they're not paying for their own food, clothing, shelter, if they're saving that money for another purpose, that's not providing more than half of his or her own support. If someone else is doing it, that's fine. And it does not necessarily have to be the taxpayer. You may have a taxpayer who's going to claim a child, but they might have an aunt or an uncle or a grandparent who's actually paying support. The other things to keep in mind here as well is that things like scholarships aren't going to count against that. So we're not going to treat a scholarship as a child providing more than half of his or her own support. As I mentioned before, we have the joint return test. So they cannot actually file a joint return. But as always, we have an exception. Unless the only reason to file a joint return is to claim a refund, then they can still be considered a qualifying child. And then the last one is they cannot be a child, qualifying child of anyone else who has a higher priority under the tie-breaking rules. So we're going to take a look here and get into a little bit more as we're reviewing kind of the qualifying child. We have a very broad category here for relationship test. So theoretically, you could have a child, and depending on the living situation, you could have an aunt or uncle trying to claim them, the parent trying to claim them, maybe a grandparent trying to claim them, and they would all be theoretically eligible based on these rules. The relationship test, as long as they meet that relationship, they would be considered the opportunity to claim a qualifying child. Again, as long as they meet the age test, that means we're going to meet the first two pretty easily. As long as they're all living in the same place together for more than half the year, we've satisfied that. And the child didn't provide more than half of his or her own support. Okay, we're pretty good. But the IRS knows that there's multiple opportunities for people to try and claim a child. So what they want to try and do is determine who has a priority when you claim a qualifying child. And in fact, what will happen is generally the first person to take a child as a dependent on the tax return and electronically file for that year will effectively lock that Social Security number down and preclude someone else from making a claim of a qualifying child. So I just want to go through a little bit here what that will mean. And also just want to clarify here that when we talk about not provide more than half of his or her own support, if they are getting support from a state or other agency, that's not considered support from the child. So if they're getting some assistance or they're getting some support from a state agency, not considered providing more than half of his or her own support. Now, if they do get SSA benefits because of a death or disability for a parent, then that is considered the child providing income, but it all depends on how those funds are used. But let's take a quick look at the tie-breaking rules here. And this is on C4 of your 4012. So if we have multiple people who may try and claim a child, we're going to take a look and see if only one of the individuals trying to claim the child is the parent, then the parent's going to automatically win the tie-breaking rules. So if a parent tries to claim a child and someone else does, an aunt, an uncle, a grandparent, then the parent has the first priority to claim the child. If both parents, and again, the IRS has to clarify, who are not filing a joint return, I'm not quite sure why we need to clarify that, because It shouldn't be an issue if both parents are filing a joint return. It doesn't really matter. It's all in the same return. But this would be a situation where the parents are not filing together, and we have both parents claiming the child. Then the default position for the IRS is to take a look at the parent who has the greatest amount of time with the child, effectively how we refer to as a custodial parent, the one where the child spent the majority of the year, the greater portion of the year. So that is our default position by the IRS. I'll give you a couple examples here as we walk about parents who might have a shared custody or some other type of arrangement. But the default position for the IRS is wherever the child spent the greater portion of the year. If both parents are claiming and the child spent the exact amount of time with both parents, then what will happen, the IRS will then go to the person who has the highest adjusted gross income. So whoever has the highest income would then get to claim the child. Following that, if no parent can claim the child, so if the parents aren't actually in the picture or maybe not filing a return, then if we have multiple people trying to claim, then the next scenario goes to whoever has the highest adjusted gross income. Lastly, we have a situation where if a parent can claim the child but chooses not to do so, this could be a scenario where maybe the parent has a very low tax burden. Maybe they don't have enough taxable income to pay income tax. Maybe they're in a situation where perhaps they really aren't not going to be filing a return. There's no benefit to claim the child. Then someone else can claim the child. So as long as that individual who's going to claim the child has a higher adjusted gross income than the parent, then we're okay. So as long as the individual trying to claim it, and it could be a situation where you may have a parent living at home, they have a young individual as a child, but maybe they're still in school, maybe they don't have a sufficient amount of income, but they're living with their parents, then the grandparent may be able to claim their grandchild as a qualifying child. So the good news is, while I want to explain this to you and really kind of get into the opportunity to talk about tax law, other than probably taking a look at the certification exam, we may not need to hit this much harder because generally we don't have as much of these situations. On occasion, they may crop up, but I just want to make sure you have the guidance to be able to walk through these. So if you are preparing returns, it's generally a good idea to understand how to refer to these rules so we can explain those to the taxpayers. Now, I did mention that we have a special rule for non-custodial parents. So on C8 of the 4012, you can take a look here and determine that there are certain benefits that go along with a qualifying child. So whoever claims a qualifying child can get the following benefits in addition to the dependency. So it could either be the credit for other dependents or the child tax credit. Also follows the head of household status and the earned income credit. Also the credit for child and dependent care expenses, and also allows you to exclude from income any dependent care benefits. So this is someone has gone ahead and they've elected to have dependent care benefits, generally for child care, done on a pre-tax basis on their W-2. We'll talk more about that again next week as we talk about how we would report income. But what if we have a scenario where we have a parent who has primary custody? Again, the IRS would default to the position whoever has the child for the greatest period of time should get that dependency exemption. But oftentimes when we have a divorce situation or there might be a custody battle, there may be a situation where the non-custodial parent should be granted dependency of the child. So oftentimes that's probably going to come from a divorce scenario. So two things we want to take a look at. We can always caution the non-custodial parent that the default position for the IRS is that child's going to go with the custodial parent. However, if they have a signed Form 8332, and this is basically a signed document generally done at the time of the divorce proceedings that would allow the non-custodial parent to take that child in certain years or for a certain period of time, that would protect the non-custodial parent. That's going to make sure the IRS would still give dependency to the non-custodial parent. Or if there is a divorce decree before 2008, which states the child can be claimed, that can work too. The best defense for a non-custodial parent would be that Form 8332. Also, when we take a look here, you can actually have a non-custodial parent going through here. Okay. And a non-custodial parent still can claim the child for child dependency purposes, and they can also then take the child tax credit and the education benefits. So when someone releases their ability to claim a child, the custodial parent can still have eligibility for the earned income credit. They can still take the child and dependent care credit. They can take the exclusion from income for the dependent care benefits, and they can still qualify for head of household. So importantly, for a non-custodial parent, they're not going to meet the head of household rules just based on taking a child as a dependent. They still need to have the child there for more than half the year. So maybe just a quick reminder to those that might have a non-custodial parent. Just saw we have a question that came in. I apologize for that. What if a parent filed after someone else filed before as the parent locked out? Technically, yes. So what would happen is we cannot electronically file that return if someone else has claimed that child on the return before. Now, not all is lost. We can still actually paper file that return, and then the IRS now has two different returns, both trying to claim the same child as a dependent. So at that point, then the IRS will come back. They'll contact both taxpayers and basically ask for some sort of proof documentation of who has the stronger claim for the child. And that's why we'd go back to these to the tie breaking rules here on C4. So the IRS would help determine what that is. So we happen to have this quite a bit, and it can happen in one of two ways. Either someone else went to go ahead and claim the child on the return, or maybe have a child who's so anxious to get their income tax return done that they've either prepared the return themselves, or maybe they went somewhere to get it prepared, and whoever prepared the return either failed to ask or did not notice that that child has now taken, basically said that no one else can claim me as a dependent. If that's the case, the parent gets locked out. We can resolve that fairly easily. It may have to be an amended return for the child to go ahead and modify their return. Generally, there's probably not going to be much impact to their tax return, but we do see that on occasion. Usually, if we can catch that fairly quickly, it's not too bad. Otherwise, we refer to that as summer work. So post April 15 amended tax return planning. So if you're not running off to take vacation on April 16th, there could be a couple amended return opportunities for you. All right. How are we feeling? Any additional questions on qualifying child? And again, we kind of changed our rules here. We have a little bit more of it's beyond someone who's probably going to order off the kid menu at a restaurant. We're talking about people up to the age of 23 and a college student. Okay, so the next thing we're going to take a look at here is going through and take a look at a qualifying relative. So qualifying relative, more information on C6. Interesting definition we'll have here. So we're always going to go through the qualifying child test first. So the qualifying child test is going to be the one that actually is one that is going to preempt anything else. If you're a qualifying child, you stay in the qualifying child realm. It cannot go any further. But if someone's not a qualifying child, either they don't meet the age test or something else, then we take a look at the qualifying relative. And the first definition we have, I'm not a huge fan of the IRS naming it qualifying relative. I would prefer the term other dependent, because one of the definitions of qualifying relative, and I actually have it listed up here first under the either category, is someone who lives with the taxpayer all year long as a member of the household. They do not need to be related to you. So as long as that relationship does not violate local law, you can have someone else living with you for the entire year. That could be maybe a companion or a significant other that you're not married. Could be a friend of of yours that decides to stay at your house for a couple days, and that turns into a couple years. You know, whatever that relationship could be, that they're a member of the household. They're living with you for the entire year. And what we mean is literally from January 1 through December 31. It has to be for the entire year. So it does not have to be related, but they have to be there for the entire year. Now, we can also get there through a relationship test. And what we're going to take a look at here is a relationship test is effectively anyone you would ever find in your family tree, with a couple noted exceptions here. So when we talk about relationship for a qualifying relative, we're talking about a child or stepchild eligible foster child. So those are still all in play as well. Any descendants as well. So grandchildren, great-grandchildren. So we're looking at kind of taking a look at the taxpayer and moving down their family tree. We also go across. So that includes your brothers, your sisters, your half-brothers, your half-sisters, step-brothers, step-sisters. Also now moves up. So now we are moving in a ancestor fashion. So your mother, your father, your grandparents, great-grandparents, or any other direct ancestors. Now, foster parents don't count, unfortunately, but stepfather, stepmothers do. Mother-in-law, father-in-law will as well. Nieces and nephew count because we're going to go your brother, we're going to go down. Your aunts and uncles, so we go up as an ancestor and we go across. So aunts and uncles count. Also by marriage, so all of your in-laws, brother-in-law, sister-in-law, like I said, father, mother, son-in-law, daughter-in-law, all count. Now, when we're done going through the iteration, there's a fairly obvious hole here in a family relationship, and that is a cousin. So a cousin does not actually fit into the related to the taxpayer category. However, if you have a cousin that you want to take as a qualifying relative, you have to make sure they live with you for the entire year. Tax law is always interesting to determine where it came from and how it's applied. I can only surmise that sometime when they were developing the rule for qualifying relative, some congressperson out there does not like their cousins, and that absolutely no way want to allow a cousin to be treated as a qualifying relative. That's my only thought as to how that may have come about. So a cousin does not count as a relationship to you, but they could still meet a qualifying relative as long as they live with you for at least for all the entire year. Now, before we get excited and say, all right, maybe when I have a New Year's Eve party coming up here, maybe I just encourage someone to come over to the party and pack a lot of things so that they're encouraged to stay not just overnight, but maybe for the entire year. One of the main categories we have here is they have to have gross income. Now, this amount has jumped up from last year, but they have to have less than $5,050 of gross income. Now, gross income does not include state benefits. It does not include income from a sheltered workshop, but it does include any money that they're earning. So that would be any wages. It could be additional compensation. It does not include things like scholarships. It does not include inheritance. So that's not going to count for gross income. Also, Social Security does not count as gross income unless that individual is married filing separately, or their half their benefits and some tax exempt interests exceed 25,000. But relatively rare, we'll find that here in VITA. So typically, we're looking at gross income. When we mention that, that's predominantly things like wage earnings. So again, if you have someone living with you all year long, and they get a bright idea as we get closer to the end of the year that they would like to pick up a little bit of spare income, probably do not necessarily encourage them to do that if you're looking for a qualifying relative dependency. Because once they meet more than that $5,050 category, they can no longer be considered a qualifying relative. Another area that we take a look at here is now the difference of support. For a qualifying child, it was just the child did not provide more than half their support. Now, for a qualifying relative, we have to look and determine, did the taxpayer actually provide more than half their support? So that's going to be our main category here to make sure that the taxpayer is the one who's actually providing support for the qualifying relative. So that changes up just a little bit from our child definition. So predominantly where I believe we see this within VITA, you could actually have a taxpayer who might be supporting their parent, their elderly parents, or maybe elderly grandparents. Again, they don't actually have to live with them as long as they have relatively low income and the taxpayer is providing more than half their support. It could be that you may have an individual who's living with you, but does not have sufficient income. They could be considered a qualifying relative as well. How are we feeling on the dependency side of things? I know we're about an hour in already. How are we doing so far? Okay. Good news is if you've done this before, we have no substantial changes to dependency. But now we're going to move into the category of filing status. So at the very beginning of our session, we talked about how do we determine whether or not you need to file a return. And we talked about 5 different filing status here. Again, B13 and B14, that's going to be where you find the information in your 4012. I apologize. It feels like I'm calling out bingo numbers here. when we're talking about B13, B14, or maybe talking about vitamins. But we're talking about where to find these on the 4012. So we're going to talk about our filing status. The first one we're going to start off with here is our single status. Generally, the easiest one, our most basic status. What we determine is your very last day of the year. So December 31, what was your filing status? So if you were unmarried, you're going to be considered single. Here in Pennsylvania, we don't have a legal separation category. But if you're divorced by the end of the year, you would be considered single. We don't have legal separation in the Commonwealth here, but a divorce would, as long as that's completed by the end of the year, you would be considered single. But there could be some other filing status we could take a look at. So we'll take a look and see, does anything else apply? But we're basically looking, what are you at the very end of the year? Are you not married? That's our basic definition. If you're not married at the end of the year, you're going to be traditionally single. And again, we don't really care what your Facebook status is. It doesn't mean in a relationship where it's complicated. If you're not married at the end of the year, you're traditionally going to be considered single. Now, we sometimes have people come in and maybe on their intake sheet, they may mark off that they're a widow or widower. And we have to ask, and I believe the intake sheet has now been updated to put the year in which the spouse had passed away, which may help preclude some of these questions, because we sometimes have people come in and say, filing status, while my spouse has passed. And usually our first response is, I'm so sorry to hear that, must be a difficult situation with your spouse passing. What year did they pass away? 1968. Okay, well, that's a little far away. You are actually considered single under the tax law. If you have a taxpayer who died before 2024, that widow or surviving spouse is going to be single unless they meet another definition, which we'll talk about in a little bit. All right, how are we feeling on the single category? Usually if someone comes in and tells us they are unmarried at the end of the year, we will take their word for it and understand that they are single.
Jared,
Yeah, I'm sorry, Nat, go ahead. Yeah.
yeah, this is Annette. Question for you, and let us know if we did this correctly. We had individuals, we had Afghans that met the residency test and were working in the United States. They were married, but their spouse was still back in the country. They were not in the United States.
Right. Okay.
It was just the single man was here, or just this individual was here.
Right.
We filed him as single.
Correct.
Is that the correct approach, as opposed to
Yes.
be married filing separately or married filing jointly?
Yes. So that gets into some of our international discussion, but traditionally what will happen is the U.S. will only tax you on income from individuals who have a connection to the U.S. So in that case, the individual, and was your individual intending to be here in the U.S.? Were they considered a resident alien at the time, or have some other status?
Yes, they were resident aliens. We did the
Okay.
calculation to
Yeah, perfect.
determine
Okay.
they were resident aliens, but they were married, but the spouse was not here in the country.
Yeah, and that becomes an interesting question. I actually have a situation similar where I actually have a individual who's married to an individual who does not live in the U.S. We have always filed her as married filing separately for our purposes, but in your case, because we're looking at the resident alien component, typically we would just file them as a single individual and not include the income from the non-resident spouse. So typically we don't be looking at the income from the resident alien.
Okay, thank you.
Yeah, absolutely. Okay. So that begs the next question. What happens if people are married? So we can have them file jointly. And again, we just double check the last day of the year. Are they married? If they're living together, that's great. If they're married and living apart, that's all right too. We can still have them file jointly. Are they separated under a separation agreement? Again, we don't recognize that under PA law, but they can still be considered married. Common law marriage, again, PA does not recognize a common law marriage, but federal government can allow that for states that do recognize common law. Effectively for PA, what we want to ask is, are you still married as of the end of the year? So most taxpayers know if they're married. I mean, hopefully they understood that they got into a marriage situation, and they should also know whether that marriage has ceased. So if they're not divorced, if they're going through a divorce procedure and it's not completed by the end of the year, they are still considered legally married. So they can file a joint return, and we'll give you a couple other options they could file if they don't want to file together. We'll also talk a little bit about what happens if the filing status of married filing jointly is better than married filing separately, which it often can be. We have done in the past within VITA, we prepared the returns without the people there at the same time. As long as we can get all the information, we can actually go through the return, prepare it, and have each individual sign without having them sit next to each other for a full appointment. But now the difference here is when an individual has passed away during the year. So if you have an individual and they check off the box that they're married and their spouse has died, as long as that spouse died in 2024, they can still file a joint return as long as they were married at some point during 2024 and the surviving spouse has not remarried. I haven't seen a whole lot of these. Usually, if we see that situation where a spouse dies suddenly from a very unusual circumstance, and then we see the surviving spouse get married a couple days later, usually we'll probably see something else get involved. Maybe it'd be a great Dateline episode or probably some legal environment happening there. But if that does happen, if someone says, well, my spouse died in January and by the end of the year in December, I got remarried, then the spouse is going to file a return with the new spouse. The deceased individual would have to file a return showing their income as married filing separately. And great question. We just had someone here. Dolores had asked if you have a married filing separately, would you need a social security number? And you technically would. If you don't have it, I'll talk about married filing separate in a little bit. There is a code you can use. I believe it might be all nines. I think it's in the 4012 that you can use if you do not have a social security number for your spouse. You would then have to paper file the return, I believe, to get the IRS to process that. And then Peggy had a question about list somewhere what doesn't count as QR gross income. So the qualifying relative income. Yeah. So if you take a look at your charts for the qualifying relative gross income, I apologize for that I didn't catch that earlier. That would be in the C6 category, and also as a compendium to the 4012. Correct me if I'm wrong, Kim. Is it the 4481? There's another guide that we use a little bit more specifically for training. I actually downloaded a copy of that as well. That goes into a little bit more detail. And so I'm going to try and.
It's the 4491.
4491. Okay. Sorry, I got half the numbers correct there. I appreciate that. Appreciate the assistance there. Yes, the 4491 has some very good examples. The 4012 we use is a great desktop reference. It has a lot of flowcharts, but the 4491 will have a couple more examples that I'll walk through. I use it quite a bit because it does help have some explanatory information, and that's generally where you're going to find some of these questions about, is there a difference between state aid and other types of income coming in? And usually the 4491 will go ahead and have those for you. Appreciate that, Ed. Thank you very much. Okay, so taking a look here. So again, we're taking a look at the married filing jointly. Same-sex couples can file jointly as long as they're legally married, same as any other type of couple. We have I'm not quite sure why I still have this slide set in here, but it's if anyone is legally married in any state, any jurisdiction that recognizes their marriage, they can file jointly. It does not apply for domestic partnerships or civil unions or other types of relationships that have to be married. Again, we take the individual's word on whether or not they're married. We don't necessarily have to have a documentation. You do not need to bring your wedding album in with you to have your return prepared. We don't need to see, sometimes people say the top of their wedding cake for an anniversary later. They don't have to bring it in and share it with you, although they're welcome to bring snacks in. I think if we take a look, no cash tips, but you're more than welcome to bring in food for the for the preparers. That's entirely legal under the VITA program. We did touch a little bit here on the question Dolores had about if you are separately filing. You can be married at the end of the year and you may file separately. One of the main areas we may see is someone says, I don't want to file with my spouse because I'm concerned about joint liability. When you file a return and you both file that return, the IRS can go after either taxpayer to go ahead and collect any tax debts. So sometimes people say, I don't want to file with my spouse. I'm not entirely sure that all the income's reported correctly. And I'll mention how we can get around that in just a minute. In some circumstances, a couple may pay less tax. That is a very, very specific circumstance. And sometimes we have to run, I think Ed mentioned earlier in our morning session, he's run into one where the married filing separately did work due to some disparity in income. So it can work out in some very limited circumstances. But we generally do not recommend it because what happens when you file separately, you're going to lose credits. So that would be the earned income credit, elderly credit if they were eligible, child care credit, adoption, and education credits. So again, if they have children, they're going to lose education credits. They're going to lose child care credits. They're going to lose EIC. They can also lose some education benefits. Again, we don't see this as much, but student loan interest deduction would not be available. Savings bond interest exclusion will not be there. If one spouse itemizes the deduction, then the other one also has to itemize. That's when we took a look at the chart that $5 was our threshold for someone who's married filing separately. When you're married filing separately, a greater percentage of Social Security is going to be taxable at a much earlier position. It's still going to only be up to 85%, but it's going to be taxed a little bit quicker than before. Also, a couple other limitations. So one of the areas we take a look at is there are a lot of detriments to filing separately. So we may encourage people to try and file jointly if possible. There may be a couple reasons people give for not wanting to file together. One big one may be I don't trust my spouse. I don't know that they're reporting all of their income, or maybe I'm not entirely sure that their deductions are correct. The good news is that there is a position with the IRS called an innocent spouse relief. So if there is a position where a return has been reviewed for examination and there is additional assessment, the spouse may file for innocent spouse relief, meaning that the issue is entirely on the other spouse, that they're not liable. Now, in order to get innocent spouse relief, they have to purely be innocent, meaning that they were not aware that that return that they had signed had information that was incorrect. So that means they cannot have been part of the process that may have involved the understatement of tax. Maybe a good example would be if someone's reporting they have business income of $5,000, that's their only source of income, but the spouse should have been aware that they're living in a very nice house, that the mortgage is paid every month. They have 2 vacation homes. They also spend some time away at the beach for a month at a time. They have a brand new car every 6 months, that they go out to dinner virtually every night, that probably you're not actually living on $5,000 of income. So the IRS is a little leery if there's some activity there that the taxpayer should have been aware that there was more income. But generally, if they have no knowledge that their spouse may have been underestimating income or overstating expenses, then innocent spouse can prevail, and that would preclude the IRS from going after the innocent spouse. Another scenario that we hear, and I actually see this a lot more in practice, is a couple may say, I can't file a joint return because the IRS is going to take all of our refund. My spouse owes money, whether it's back tax liability, whether it might be maybe in the case I usually see, it's student loan payment. It could be child support payment. There's some sort of garnishment to that refund. And so they may come in and say, I can't file jointly. I'll just have to file separately if I want any money back. Well, the good news is there's actually a form within TaxSlayer. It's called the Form 8379. It's called an injured spouse form. And the injured spouse form you can actually prepare within TaxSlayer. You can electronically file the return. It takes just a little bit longer to process that refund because it's going to be manually reviewed by the IRS Center in Austin. But what they'll do is that you can actually split the refund between the two parties. So this really works out well, especially in situations when we have a married couple with 3 children, so they can still get some of those additional credits. They still get the education credit. They still can get the earned income credit if eligible. But what's going to happen is they can file at a much more favorable married filing jointly position, and the refund's going to be split between the two. So the injured spouse can still get their portion of the refund, and whatever the spouse that owes back money to the government, the government's just going to take that portion. They will not take the refund allocable to the injured spouse. So works out very, very well. If you have any situations along those, I highly recommend taking a look at the injured spouse opportunity. If you're new to that, hopefully we can have you talk to a site coordinator to help go through that process. Okay. Oh, yes, I'm sorry, Ernie. You asked about a morning training session. So what we actually have here for the Lancaster County, we actually have an in-person morning training session, and then we follow up with an evening Zoom session for those that are unable to make the morning session or a little bit more remote. So we're going to provide the exact same content between the two sessions, just a little bit of a different audience. We do have wonderful coffee and refreshments at the morning session. So I do apologize. We can DoorDash if you need something, I believe. But the content that we're going to be talking about is exactly the same. Slide set's exactly the same as well. Okay. So married filing separately, again, we have some downside of doing that. How are we feeling so far with the first 3 filing status opportunities? Before we get into the one that everyone loves to try to claim, the head of household. Head of household, I love the title. Who does not want to be head of the household? I think for head of household, it means that you have the ability to make decisions. You're going to have to be the one that when everyone asks, what are we having for dinner? And no one knows, you get to say, here's what we're going to do. It's like when I grew up, if I asked, what are we having for dinner? It's whatever's on your plate. That's what you're having for dinner tonight. Head of household's going to make the decisions about where you're going to go on vacation, all those other good things, right? Head of household sounds great. We often have people who get tax advice from friends of theirs, coworkers, and we may have people come in and say, well, my best friend told me I should be head of household this year. Okay, great. Is your best friend a certified VITA volunteer? Do they have an enrolled agent certification? Are they an experienced tax preparer? If no, then we have to make sure you understand the rules of what a head of household is. So head of household can help in a variety of ways. As we took a look at that chart in the very beginning, the head of household has a higher standard deduction than just a single individual would. So there's some benefit there potentially of having less taxes you need to pay. In addition, because we have a graduated income tax rate system, the head of household will have lower tax rates for a little bit longer than a single individual will. But what we want to take a look at here is what are the actual tests for head of household? So the taxpayer has to be a U.S. citizen, or they have to be a resident for the entire year. So we have to make sure, particularly if we're working with refugee returns, that they have to be a resident for the entire year to be head of household. So they have to be not married at the end of the year. I think we're okay with that one. That's kind of going back to that single definition. And now we have a new terminology used only for Internal Revenue Code purposes only, considered unmarried. And I'll define what that is in just a minute. So this is where we're going to take a look at, you either have to be a single individual, and you could file single, or you could elevate to head of household status. Or you could be considered unmarried and elevate to head of household status. Now, the main key here, we're talking about household. You have to pay more than 50% of the cost of keeping up a home. The home has to be a principal residence for more than half the year. So not exactly half, more than half the year for either a qualifying child or a qualifying relative. So the qualifying child is pretty much the same definition we had for dependency. The one exception is you have to be a custodial parent. So a non-custodial parent, even though they may take the qualifying child as a dependent, will not allow them to be head of household. The child has to live with you for more than half the year. So by definition, a non-custodial parent does not have the child for more than half the year. So we cannot go ahead and have that qualifying child for a non-custodial parent elevate them from single status. They would still be considered single. Or it could be a qualifying relative. Now, the qualifying relative would not necessarily need to live with you if they are your mother or father. So there is a carve out for mothers or fathers. So we may see a situation where a taxpayer may be providing more than half the support for their elderly parents that may not be residing with them. They could be in a nursing facility. They could be in a separate residence. So they don't actually need to be living with the taxpayer. But here's another wrinkle as well. The qualifying relative test we talked about, the exception for someone living with you for the entire year does not apply for head of household status. So they have to be one of the relative tests we had talked about. So again, cousins are out. The companion or friend living with you for the entire year is out. They will not qualify as a qualifying relative for head of household status. One other thing I just want to mention here as we go through, we talked about not married, but we also want to understand what is the unmarried or considered unmarried piece. Well, the considered unmarried is effectively where the taxpayer files a separate return. So what we're basically looking at here is the taxpayer is actually married, but they would be filing a married filing separately return. The taxpayer still has to pay more than half the cost of keeping up the home for the entire year. And the spouse did not live in the home during the last 6 months of the tax year. So this is maybe a situation we have where a couple may be going through a divorce. Maybe at that point, the spouse has moved out. They maintain their own home. And as long as that spouse is not living in the home for the last 6 months, make sure they're out by June 30. They're not in the home for the last 6 months of the year, and the taxpayer is still maintaining that home, paying at least more than 50% of the cost, and that taxpayer's home is the main home for more than half the year for their child, stepchild, adopted, or foster child. This only works with one generation down. It can only be child, stepchild, foster, or adopted child. It does not count if you have a grandchild. So you can't have a grandchild try to get you to the considered unmarried category. The child has to be a dependent or could be claimed as a dependent, but you basically waive that due to the exemption to the non-custodial. So again, they have to be living with you for more than half the year. And again, the main thing we take a look at half the year, we're going to take a look at those same temporary absences there. So that includes any vacation, education, incarceration, military, or work service. Now, the big thing, as I mentioned before, this has to be paying for the cost of keeping up a home. You need more than half. So the government does a very good job of taking a look at addresses and determining how many people are trying to claim head of household. Technically, for an address, there should only be one person who can claim head of household. We've had some situations in the past where someone may have come in and they have a very limited amount of income. They may have, I think the example is $5,000 of income. They have a young child living with them and they want to be head of household. Well, the problem is they're not actually paying for their home costs. They were actually living with the taxpayer's parent. So the taxpayer's parent was actually paying for all the costs of the home, meaning that the taxpayer themselves did not provide more than half the costs. And I'll give you some examples of how this will work. On this slide set, you'll see that we have a little house in the corner here. We're literally meaning what are the costs of maintaining that home. So B16 is going to have this information along with a chart that we can consult if needed. But what we mean is who's paying the property taxes, who's paying the mortgage, and we actually take a look at the mortgage interest expense. The reason why we look at the mortgage interest expense is because we get a document from the mortgage company, a Form 1098 that we can refer back to. But who's going to pay rent, utilities, repairs and maintenance on the property, any type of property insurance, other household expenses? And then we have another category, food consumed in the home. Traditionally, what we've always interpreted this to be is groceries that you're buying and you're bringing back to the home to be prepared and consumed. The definition here has started well before door dashing and other services, but we're looking at not restaurants, not going out to eat, but food that you consume inside the home. Now, these are costs of maintaining the home. It does not include other support costs like clothing or education or medical or vacation, transportation costs or life insurance. This is only going to be for the cost of keeping up a home. And what the IRS would do if we have a situation, and usually we can stave off any situations by telling the taxpayers, the IRS will have a chart that they use, again, replicated here from B16 of your 4012, that they will go through and they'll say, okay, what are the total costs of all of these and how much did you pay? The government's very good at checking addresses and very good at doing math. Not so great in English comprehension when we're trying to write tax law, but very good at address checking and mathematics. So what we want to take a look at is how much did the taxpayer actually pay? We'll add up all those costs and they have to pay more than half. Again, only one person can pay more than half the cost of maintaining a home. So theoretically, only one person can be head of household per address. Now, what happens if you get some assistance? What if there are other things like temporary assistance for needy families or other public assistance programs that may contribute to keeping up the home? Anything that you're getting from a assistance program does not count as amounts that you pay. That's coming from another source. But however, those payments that are being made have to count for the total cost. So for example, if your rent would be $1,500 a month, but you're getting a subsidized amount from a state agency and you're only paying $300 a month, the total cost of the rent is $1,500. You're only paying $300, so you're not at 50%. Hopefully you're going to pay more utilities and property insurance or anything else that might help us get over that hurdle, but only one person can be providing more than half the cost of the home. So again, we just want to take a look at this. Each year is going to stand on its own. Quite honestly, sometimes when people are very close, the head of household may not make that much of a significant tax difference. We're going to take a look at credits in 2 more weeks, and that's going to give you a little bit more opportunity to find out how we can really save some tax dollars. The head of household status, as I mentioned, is a higher standard deduction. If their income's underneath that threshold, it doesn't really matter. They're not going to pay tax anyway. Fortunately, within VITA, we don't have people trying to game our system, but sometimes they just need a little bit more information or education on what a head of household status is. All right, how are we feeling on these? Any questions so far? Okay. Let's take a look at our final status here, and this is going to be our qualifying surviving spouse. Now, what we're going to take a look at here, this is when all of these conditions have to be met. So the taxpayer spouse died in 2022 or 2023. So what we take a look at, if the taxpayer spouse died in the current year in 2024, they can still file married filing jointly. What we're looking at is specifically that spouse died in the prior 2 years, in 2022 or 2023. That the taxpayer could have filed a joint return in the year the spouse died. The taxpayer has not remarried before the end of the year, so as long as they didn't remarry before January 1 of 2025, they pay for more than half the cost of keeping up his or her home. And that home was the main home for the entire year of the taxpayer's dependent child or stepchild. Does not include grandchildren, does not include foster children. It has to be for a qualifying dependent child or stepchild. This is a situation where, when I've seen it, it's been for generally a premature passing of a taxpayer. I actually have a client who was killed in a farming accident at the age of 27. Still had a number of young children in the house. So the year that taxpayer had died, his wife, surviving spouse, could file a joint return with him. In the next 2 years, she could file as a qualifying surviving spouse because she was entitled to file a joint return. She did not remarry. She was now keeping up the cost of the home, and that home was the main home for the entire year for their dependent children. So year 1, married filing jointly. For the next 2 years, we can file as qualifying surviving spouse. And then subsequent years, we'd actually be able to file head of household if, as long as she maintained more than half the cost of the home for more than half the year for any dependent children. So a couple things we can take a look at: married filing jointly. These are the exact same rates for qualifying surviving spouse. it's almost as if the spouse is still there for purposes of the standard deduction and the graduated tax rate. So they get that benefit for 2 more years, as long as they still have a qualifying dependent child or stepchild at home. Very rare circumstance here. We don't see that all that often, but just want to mention that this is probably our most powerful filing status out there. Okay, we're hitting here at 7 o'clock. I think we can probably finish off just a little bit. If you need to take a break, this session is going to be recorded and I believe available later for your viewing pleasure. I believe it is going to be available on YouTube. We do have people from outside the area that do view this. I think we've gotten to the point now where we should probably have a subscribe to the Lancaster United Way VITA program so people could go ahead and follow along.
Yeah. It should
But
be up by tomorrow evening.
wonderful. Good, good. So we will have the opportunity for you to, if you need to take a break, feel free. We'll catch you up. This is the last bit here is a bit unique because, well, actually we call it unique filing situation. So I try and use plain language as best we can. So we call these unique filing situations. This is where we're going to get in. I think Annette, you had already referred to this a little bit earlier tonight. The definition between a resident and non-resident alien. So if you have a resident alien, we can certainly prepare that return. We can still apply things like dependency rules. Traditionally, a non-resident alien would be someone who is not here or intending to be here. We'll talk a little bit more about that. Where we sometimes see this might be people here on a J, an F, an M, or a Q visa. These are typically going to be students. It could be people here for work assignments or educators on a part-time basis. I should remove this because now we are able to do returns for a non-resident alien student if you have the international certification. So we're now able to do those if you wish to do the international certification. So that would be applicable for a non-resident student. So I'll have to strike that out for not in scope for VITA. As we talked a little bit earlier, resident aliens are treated identically to U.S. citizens. They're going to take a look at the filing status. We're going to take a look at the dependency rules. They're going to be taxed on their worldwide income. So if they have income from outside sources, we are now going to treat them as being taxed in the U.S. We may have some issues with foreign tax credit. Hopefully, we don't get too far into that. Most of the areas I believe we see here within Lancaster County is traditionally we probably have a resident alien that has been coming from a refugee scenario, meaning they may not have had a lot of income or any income at all from their former country. Now, non-resident alien, if they don't meet the resident alien qualifications, would file a Form 1040-NR, which stands for non-resident. So again, these could be certain refugees that may be here temporarily. I believe most of the refugees we have here in Lancaster County are intending to reside here and be relocated here to the U.S. But that could include, like I said, students. It could include teachers, trainers, or other people that are not considered a resident alien. Again, some of those situations may be outside of scope, but just double check with your site coordinator. Again, as we mentioned, we have the ability to take the International Tax Training Certification, which would allow predominantly our non-resident students to be prepared within the VITA system. So the question may be, how do we determine if someone's a resident alien? Great question. This is all the way down in L7 of your 4012. So there are 2 different tests we can use. The first one, the green card test. So if they have a green card, which means they're lawfully permanent residents of the U.S. at any time during the year, they are considered a resident alien. They are not a U.S. citizen yet. They have a green card, which means they're allowed to be here legally. Now, just to keep in mind, that card is no longer green in color. It's called a valid alien registration card. If someone comes into your site and they bring a card on a green sheet of paper, that is not an actual green card, no longer green, but it will say a valid alien registration card. It indicates that they have lawful permanent residence in the U.S. Another way to take a look at this is a substantial presence test. There is a chart on L3 of your 4012. We generally have to count the amount of days that they were here in the current tax year and the prior 2. the first year can be a little bit tricky, but if they're here for at least 183 days, they're probably going to meet that substantial presence test, and then we can treat them under the VITA program. And as I mentioned, we do have a couple individuals here who are international certified, so they can help out with that process. So if they are a resident alien, we're going to file a regular Form 1040 and apply those tax laws. For tax identification numbers, I just want to kind of give a quick overview here that we do need to have a valid number on the return for each individual. So every person listed has to have a tax number. Hopefully they have a social security number. If they're somewhere within the immigration process, they may have an ITIN or an individual tax identification number. If we're going through the process of adoption, that would be an ATIN, an adoption taxpayer identification number. So whatever they have, we have to have that on the return. So if an individual comes to you and they have an ITIN, that's what we're going to use as their primary tax identification number. However, they may have a W-2 that might be different. It might actually have a social security number on it. If that's the case, what we want to do is use that ITIN on the tax return. So that's going to be on the 1040. We're going to use the ITIN as their primary number, but then we're going to enter that W-2 exactly as it's prepared. We're actually going to override the number and put a social security number in there. So generally with an ITIN, you're not going to be eligible for the earned income credit. However, if they have a social security card and it says valid for work only within the INS or DHS authorization, then they may be able to claim the earned income credit. If you have a dependent that has an ITIN, they're not eligible for the child tax credit. They need a social security number for the child tax credit. So just a couple little wrinkles. Fortunately, when you enter the information in a tax layer, it's going to know exactly what to do to handle these. So just want to be sure that we're doing well with this information. Again, a little bit more of some unique filing situations. With these, if it's the first time you're seeing these, feel free to take some time, make sure that we have enough dialogue to make sure that you're feeling comfortable with the return before it goes out the door. As we mentioned, every return will go through a process where we have preparing the return, and then a secondary review, a qualified review happening on the return. So we want to be sure that we're preparing the information as correctly as possible. So that is pretty much where we're at for our legal overview, kind of our tax law portion of the first session. Be happy to answer any questions you may have with any of the information we've talked about tonight. In the upcoming weeks, a little coming attractions for those of you used to streaming, series on the internet. Next week, we're going to be talking about sources of income. The following week, we'll talk about deductions and credits. And then the fourth week, we'll talk about any remaining tax issues. That includes some state and local taxation as well, more applicable for those here working in PA. But happy to spend some time this evening. If anyone has any questions that haven't gone through chat or you haven't had an opportunity to ask at this point, feel free to hang out for a little bit. Not quite sure, Kim, if you have any parting words of wisdom for anyone at this point, but happy to stick around here.
Okay. The only thing that I can mention is, again, if there's anything that you heard on our video tonight and you would like a copy or information, please send me an email with whatever it is that you would like, and I will get it to you as soon as I can. For those of you that maybe came in later, I can send a copy of the PowerPoint presentation that Jared had tonight, if you'd like to keep it for your records. But again, please email me. Other than that, I have nothing else. Hopefully we'll see you next week. And I will end the recording, but Jared, if there's anybody that has questions, you can go ahead and continue.
Okay, thanks, Kim.